The S&P 500 finally is in a correction. First time in a year and a half where from a record peak to a close, it has dropped slightly over 10%. 10% is the magic number that we have arbitrarily given as a 10% correction. But but lots of stocks are down a heck of a lot more than that, especially the big ones, the Mag 7, the FANG stocks that we've been talking about endlessly for like the last 5 years. So, pretty glum. Investors are pretty miserable, but there will always be down markets. Down markets and up markets are not separate, they're just part of the market. And we need to talk about what you could do now to set yourself up for the eventual recovery. That's what we're going to talk about. So let's just roll a quick intro. As soon as I find that button, and it should be here. Here we go. Okay, stick around. We're going to talk market opportunities. If you don't mind, give us a thumbs up while you're watching this. I'd love to hear from you. So hit me up in the comments section with your questions. And here we go. All right, thank you for joining me. I see somebody out there watching. Hey guys, if you don't mind, if you're watching, obviously you're watching if you're seeing this, uh, give it a thumbs up. I will actually see who it is, and I'd love to see you, give you a shout out, and get a gauge, for who's watching. So hit that like button. Ask your questions in the comments. The S&P 500 is officially in a correction territory. What does that mean? From a closing high, not from a high during the day, because the closing high of whatever the record is of the high of an index is not necessarily the same as the high of the day of that day. Like the market could have been up a lot that day and only closed up a little bit that day, but that could still be a closing high. By the way, you can't invest directly into an index, but you could invest in a security that tracks or mimics an index. So we are a little bit more than 10% lower from a closing high, record closing high, to where we are now, to where we closed today. And the closing dates are the ones that we go by, not necessarily the daily highs or daily lows of any given day. So, we look at closes. And this has happened. This happened many times before. I've been doing this 35 years, and I still don't know why people. It just seems people are getting more worked up now than I've seen in other 10% corrections. While you go through them, they do appear very scary, and the one you're going through is always the worst one that we've ever had. And the one after this will feel like it's even worse than this one. And I can give you the negatives, which I think it's worth saying. I'm going to do some broad strokes, but you don't really need me to point out all the negatives. You have regular TV and financial media for that. But if you are taking the time to watch this, I just want to say stimulus from the bear market or from the pandemic era is completely gone. That not just means money giveaways to people, but Fed policy is no longer easy. Quantitative easing is no longer there. Interest rates, short-term interest rates, are considerably higher today than during the pandemic. During the pandemic, they went down to zero. Now they're about 4.75% in the Fed funds rate. So we've run out of the stimulus, and our trading partners have run out of stimulus also. Everyone did the stimulus who could do it, including developed nations. So having said that, we are now looking at trade wars, and it's just this off-the-cuff stuff. For example, Europe says that they're going to put a 25% tariff on incoming bourbon and whiskey. I don't know if it's all American alcohol or just Kentucky whiskey. So Trump says we're going to put, I don't know if he said a 200% or 250% profit. Tariff, some big tariff, just right on, European alcohol. Was that a thought out strategy, or is just, oh yeah, or is it think something like, oh yeah, well I'm going to do this, well I'm going to do that, well now I'm going to do this, like it's just one upsmanship, but they're playing with people's lives. They're really messing people's lives up, and there's no rhyme or reason to a lot of this. I'm going to say any of it, uh, because it's just one reaction after another of a single individual, and the whole world has to pay for it, in particular Americans. So we're trying to figure this out. Now, you could say that Trump maybe doesn't care so much about the wealthy as it's made out to be, because the wealthiest people of this country own most of the stocks. And since stocks are getting crushed right now, you could say he's turned his back on the wealthiest people. But there are a lot of people who are not considered wealthy who have a 401k plan, an IRA, they have accounts. Now, Bessent, the Treasury Secretary, he says they're not looking at the market, and the market will have its short-term hissy fit, and that's part of the process of investing, and we're going to make the economy stronger, and that'll be reflected in the stock market with higher prices one day. You just have to take your medicine now, and it'll be worth it. So, we have to go through some discomfort, to get through a hard moment, to get to a better. We have to go through a hard moment to get to a better time in the future. Now, I actually don't like it when politicians gauge anything by the stock market. The stock market is how we judge reaction to policies and the economy and individual companies. Inflation, interest rates. So I don't really like it when the stock market becomes a part of politics, except the stock markets are the final arbiter, the final judge of what political policies and economic policies could get away with. And eventually the market does go down, and this happened. I remember, I'm old enough to remember during the pandemic, not during the pandemic, I'm sorry. I'm old enough to remember during the Great Recession when the US government decided not to rescue Lehman Brothers. And Lehman Brothers tanked and went out of business, and it basically brought the US economy to a standstill. And a few days later, big, massive economic packages were brought to Congress, including TARP, Troubled Asset Relief Program, for like $700 billion. And Congress voted it down. And the stock market, which had already been tanking, tanked even more. That was also a reflection with the stock market tanking that banks were freezing up. Loans were no longer available. People's credit lines are all of a sudden closed. You go to the mailbox, you get a letter in the mail and says, by the way, that line of credit, that HELOC, you can't borrow anymore. It's closed. I mean, what you've borrowed, fine, pay that back according to the terms, but you can't get any more access. And people just lost access to cash that they needed to get through a tough time, and it caused businesses to go under, it caused consumers to become bankrupt, foreclosures, etc. Anyway, the market reacted seriously bad, and so Congress got back a couple of days later and did pass the Troubled Asset Relief Program. So markets do have a say, and ultimately it's the markets that will be the last thing that can force the hand of Trump. The Senate can't do it because the Republican Senate will do what he wants, and same with the House, the Republican section of the House. Now, this isn't a knock on. I'm not getting into politics. I think it's fair to say I'm describing something realistic. But the market is the thing that could stop progress in any economic policy. Ultimately, when the market goes down, it causes other things. It causes a loss of wealth amongst the citizenry. It causes a lack of mergers and acquisitions, but it also is an indication that the economy is stressed. And if the economy is stressed, banks stop making loans. Uh, Companies start to get worried that their payroll isn't safe. For example, you could see a couple of uh, you could see a couple of weak banks go under. I think it was what, um, 3 years ago that Silicon Valley Bank went under, and then it brought down First Republic Bank and a few other small banks, and that sent a shockwave through the economy. But the Federal Reserve was there quickly to bail them out and you know move all those banking assets of those out of business banks onto the books of other banks, and then we kind of forgot about it, went right along. There's always a calamity to worry about. This one is definitely uh, this one is definitely a man-made one by one particular man, and it's just this off-the-cuff policy policy decisions without rhyme or reason. Like did you speak to your cabinet about this? Did you speak to the people who you've chosen to be your advisors about this, or did you just say, "I know better"? So this is what I'm going to say. Because if you're saying to Canada or Europe or Mexico, well, now I'm going to double my tariffs from 25% to 50% or make him 200%, he's not getting the reaction that he thought he was going to get. These countries are not coming back and saying, oh, no, please just tariff us on 25%. We promise we won't say a word. They're all going to play ball. This isn't, no one's rolling over. None of these countries or trading blocks are going to roll over. And it's going to result in less money for consumers and for businesses. And it's just wild indecision. Trump talking about annexing Canada and Greenland. It's not productive. I mean, unless he wants to take a page out of Vladimir Putin's book and just start taking over whatever country he wants to take over for whatever benefit he thinks he's going to get. Now, this is scaring the heck out of the markets. And I wish I had something to sugarcoat it with, but I said earlier this week that if we get away with only a 10% correction in all three major averages, I'll be very happy. I think we could do worse than a 10% correction. I've been saying this. I still think so. It doesn't mean I'm completely out of the stock market with all my clients' accounts, or myself for that matter. I'm still a long-term investor. My clients are still long-term investors. We could be wrong. Things could turn tail and go right back up. Maybe we do have some kind of massive tariff agreement with the whole world. The stock market feels calm and the economy starts to improve. Hiring goes up, and all of a sudden, builders are building and factories are going up again. And all of a sudden, and all of a sudden we're back to the races and everybody's happy. The bad thing is, even when the economy is good, it takes so much stimulus and deficit spending to have a good economy. So maybe you need to break down the economy to get down to a base where the economy could sustain itself and build on itself. Sometimes even the stock market and the economy has to get whacked to live another day. How's that for an answer? Okay. Let's talk a little bit about Social Security. There's been something in the news that people have gotten overpaid, that Social Security paid out to people a good deal more than what their benefit should have been. Now, a lot of politicians and people are pissing and moaning about this, say, how could these people pay it back? It's called clawback cruelty, because these people during the Obama administration and the first Trump administration, you had to pay that money back. During the Biden administration, you said, well, if you got that money, you just have to pay 10% of it back. And Trump wants to go back to saying paying all of it back. Not saying they are doing that. They're making that policy, and it starts at the end of this month. I happen to agree with that. If you got extra money, more money than you were entitled to for Social Security, what entitles you to only pay back 10% of it? That's like winning the lottery. And the government is not supposed to make people into lottery winners. And if you do that and they took too much money, that's not fair to people like me who are younger and are still paying into Social Security. We deserve to see that money spent properly, go to the people who it's entitled to, but no more. So I think the clawbacks should be that way. If there is a massive, or if you have a major economic, if you're not able to pay it back, you could appeal it. You could talk to the IRS, Social Security Administration, rather, and talk to them about some kind of payment plan or how you're going to pay it back. But just because you should know if you got a lot more than what you're supposed to get in Social Security payments. If you got more and you're thinking, well, I'm just going to sneak this one by and spend it and not say anything and play dumb when I got it, that's not cool. It's not that extra money is not your money. It's actually our money for the future. It's not yours. If you want to fix Social Security, raise the youngest claiming age from 62 to 64. If people do have a hardship, they should be allowed to apply for Social Security benefit at 62, and make the age make the age of having to take Social Security 73 instead of 70. I mean, right now, required minimum distributions have to take place at 73. I think it's a good number. It makes sense. Do that with Social Security. You could delay it till you're 73. The other thing that should be done is get rid of the unlimited COLA, cost of living adjustment for Social Security. Right now, if inflation is 10%, you could get a 10% increase in Social Security. But ultimately, that'll mean that Social Security payments could go up an endless amount. And I think you should limit the COLA to any year to 5%. All right. If inflation is 9%, you're still limited to 5% inflation cap for your COLA on Social Security. I think we need to do that because eventually Social Security payments are going to just keep going up so much that there's no way it'll be sustainable. And I only say all these things, because I do want to see Social Security become sustainable. And I think this is how to do it. When Social Security was created, it was created at a time when when Social Security was created, it was a time when people's living span in America wasn't as long. But people are living longer, and it's wreaking havoc on the claims paying ability of Social Security. Now, if Social Security, it's not going to stop paying. Worst comes to worst, it runs through its accounts, and it simply now has to rely on payroll taxes, which means in about 8 or 9 years, people will get a 20% cut to benefits. So it doesn't completely stop. But having said that, that should be fixed. It needs to be fixed. The other thing, there is an income cap. So if you make up to $176,000, that's the cap for 2025, around 176. But you have to pay into Social Security 6% of your income, 6.2% of your income, up to $176,000. Well, maybe we should make that income cap 250,000 or 500,000, with a phase out from 176 to 500, for example. So the time you get to 500, it's not a full 6.2%. That would be very helpful too. So you get I don't know if you want to call it a cut in benefits by raising the minimum age to claim Social Security from 62 to 64, but at least, people say we don't want to cut in any kind of benefit in any kind of way. We only want a higher tax rate to fix it. This is a compromise. Nobody's going to like it, but we can't shout over each other and expect Social Security to get fixed. Somebody has to do something. Well, we've done things in the past to help shore it up. During the Reagan administration, we raised the retirement age, the full retirement age. We need to do that again. We need to fix it. What should the full retirement age be? Maybe it should be 68 or 69. I don't think that's such a terrible thing. I think we need to save it. There's a lot more people collecting Social Security, and people are collecting Social Security for a lot longer than anybody ever expected. So these are the things that I think could shore it up. All right, let's talk about strategies for a down market. A couple of things you could do. Number one is you could do what's called a Roth conversion. And that means when you take an IRA and you convert that to a Roth IRA. What that means is once it's converted to a Roth IRA, providing you leave the money in for at least 5 years in the Roth IRA, when you do start taking the money out after you're 59 and a half, the money comes out tax-free. So it's a pretty big tax savings. Now, if you do this when the stock market's down, so if your IRA goes from $200,000 to $100,000 and you flip it into a Roth IRA, you convert it to a Roth IRA, it's a taxable distribution of $100,000, but now it goes into an account at 100,000 that could potentially be worth 200,000 one day or a lot more. You don't have to pay any taxes on that money at all. That's one thing you could do. And if you don't want to pay the full taxes on $100,000, well, maybe convert 20 or 10% of your IRA to a Roth IRA. You don't have to do the whole thing. You don't have to have this all or nothing mentality. The other thing you could do is what I like to call upgrade on the downgrade. Let's say you have a food stock that's down a lot. It's an okay company, but it's down. Maybe sell that and maybe sell that and put that into a better food company. Maybe you want to upgrade to a Pepsi or a Coke or a Mondelez. I'm not saying these are the recommendations, but these are the premier food companies. So maybe you want to upgrade on the downgrade. What I'm saying is get rid of stocks that are like second or third string stocks in a sector that are down and upgrade and go into a better one in the sector. Typically, the best ones in the sector go down the least and recover the fastest when the market does come back. And plus, you'll have those losses to harvest, and those losses will give you tax-free capital gains until you use up all the losses. And if you don't use them up in 1 year, you could carry them over indefinitely into future years. So that's a really big benefit that you can have. I think those are two. I think those are two very worthy things you could do. The other thing is you could rebalance your account. Maybe you were too heavy into stocks. I know the stock market's come down, but it might not be too late to rebalance. Maybe bonds have become a much bigger portion of your account because the stock market went down so much. Rebalance, and you'll pick up more stocks just by getting back into the stock market from a rebalancing perspective. So if you were 40% bonds and 60% stock, and now you're, let's say, 50% bonds and 50% stock because the stock market went down, rebalance it. That means you'll move 10% of your portfolio into stocks while the market's down. That is a really good strategy also. Now, I don't know for sure if this is the bottom of the market or not. Something tells me that my ability to tell you what the exact bottom of a market is not going to be worthy enough for you to even bother listening to. And that's okay. I'm okay with that. And you should be okay with that too. But it is down. It could go down more. But if you think it's down enough for you to make these moves, then make them now. And don't worry if the market goes down more, or make part of your move. Like maybe if you're going to move $20,000 from an IRA to a Roth IRA, maybe do 10 now and 5 later and 5 at another date after that. And this way, at least you spread things out a little bit and you don't have to worry about if you caught the bottom or not. If you're just a long-term investor and you're investing in your 401k plan and you're under 50 years old, a down market's your friend. You finally have an opportunity to invest every month into your retirement plan while the market's down. If you're over 50, you might have a long way to go into retirement, so it's still your opportunity to invest when the market's down. It depends. If you're close to needing your money, if you're close to needing to start selling your investments to pay for your liabilities in your lifestyle when you retire, well, that money shouldn't be in the stock market, but you could still do something to be tax efficient, like maybe doing tax loss harvesting and upgrading on the downgrade, as we just spoke about before. There could be other things you could do with the market and take advantage of the down market. Look, this is the first down market we've had of this magnitude in the S&P 500 in only a year and a half. It wasn't that long ago that we had the last one. And it won't be that long until we have the next one. These things are just part of the process. Apple is down about 20%. Tesla's down by more than half. I guess I'd say NVIDIA is down by almost a third. That happens, but there's other stocks that are holding up okay. This is why we diversify, and this is why I've been saying for the last so long that you've been watching this, don't get too caught up in a handful of stocks. As hard as it is to take some profit off of a big winner, I think strategy is more important than the timing of it. All right. I appreciate your time. I typically don't do these live streams on Fridays, so if there is something crazy going on in the market, I'll be back in the live stream. If not, I'll see you next Monday. And if you have any questions in the meantime, reach out to me. I'd love to help you. All right. Take care. Thanks.